Welcome back to Women in Finance. Today we are discussing Module 4, Section 4 and 5, which includes what to look for in a cash flow and how to value a company. So let's start with Section 4, what to look for in a cash flow. As rising women in finance, it's essential to keep a keen eye on the company's cash flow. Let's start by understanding the importance of working capital. Working capital includes cash tied in accounts receivables, which is the money owed to a company from its revenues that it's generated. In many businesses, cash collection takes time. It raises a few questions. Is there a delay in cash collection? Is inventory growing? Are there any outstanding payments to suppliers, which are account payables? In Pakistan, working capital poses a significant challenge, especially in the energy and power sector due to circular debt. Now let's move on to the importance of tracking capital expenditure or CAPEX. This is the spending done by a company to expand or upgrade its services. In sectors like refineries and airlines in Pakistan, high capital expenditure often outstrips available cash. And lastly, you should keep a close watch on the changes in net cash. This reflects the free cash flow, which ultimately goes back to the shareholders in the form of dividends. You should note that the free cash flow is the operating cash flow after deducting capital expenditure. And now let's transition to Section 5, how to value a company. There are three ways to value a company, starting with the market value. This is where you see how much other investors are willing to spend or have been willing to spend in the past to buy the business. The second way is peer comparison. This is where you compare the business's values to other similar companies and see whether this company deserves a premium or a discount. And the third way is the cash flow method. This is the total time-adjusted value of the cash flows which the company will generate after it has paid off any working capital liabilities and capital expenditures. This basically means that it's the amount of money that is generated in a year which is left to the shareholders. The shareholders can now choose to turn this money into dividends or keep it in the business as reserves. Perhaps an easier way to explain these three approaches is to compare it to buying a house. When buying a house, you could first check what was the last price the house was sold at. The second thing you could do is to compare the price of the house to other similar houses in similar locations. And lastly, you would calculate the future value of all the future rent that house could generate after paying all the damages and repairs. So let's dive into the first approach, which is the market-based approach. The simplest way to value a company is to look at its market value. Since stocks of a company trade on the market price of these stocks is essentially the true value of the company because it reflects the supply and demand of the buyers and sellers. This aligns with the efficient market hypothesis, which basically says that stock prices reflect all available information. If the stock was cheaper than its fair value, it would attract more buyers to come and exploit the cheap price of the stock, pushing the stock price higher until it reaches its fair value. So under this approach, the best way to measure the value of a company is to see its market capitalization. Another metric under this approach is the value as a percentage of earnings, the price-to-earnings ratio relative to its own historic value. In Pakistan, the average price-to-earning ratio is 9.5x, but due to political uncertainty, the market is currently trading at 3x earnings. This indicates that the market is currently undervalued. So this concludes our lesson on what to look for in a cash flow and how to value a company using the market-based approach. In the next lesson, we will continue Section 5 and talk about the two other approaches of valuing a company. So until then, happy investing!